Studies regarding the financing of a construction project are imperative to defining the successfulness of a project from a financial perspective, as well as highlighting potentially significant risk factors associated with construction. Defining financial success is crucial for developers to measure the feasibility of a project before undertaking it. Gitman and Forrester in 1977 conducted a survey regarding how financial firms use discounted cash flow techniques to determine feasibility of projects. Of 103 firms surveyed, 53.6% claimed they primarily analyse the internal rate of return to measure the potential of a project. However, more recent studies in the few decades suggest that the net present value is also being implemented at a higher frequency than in the past. Interestingly, it has been noted that large firms and highly levered firms are often more likely to analyse the NPV and IRR than other discounted cash flow techniques. When analysing NPV, it is also important to consider the probability index to effectively summarise the NPV in a more meaningful, simpler context. Application of these three finance techniques are essential to determining the potential profitability and feasibility of undertaking the built project. The Village Building Company is a Canberra-based construction company that specialises in developing land and constructing houses. The company emphasises the importance of maximising shareholders' value and creating affordable urban communities. The limited liability company was established in 1988, and in the 30 years since then, they have constructed 4,155 houses and developed over 15,300 residential lots. The company consists of 7 employees working in the management aspect of the company and has 6 employees working on their board of directors, with different labourers being subcontracted various jobs as required. The project from the Village Building Company, selected for use in this assignment, is their proposed development in Western Creek. Various secondary sources with publicly available sources provide insights as to the development plans and have been referenced for the following statements. The company purchased a 6-hectare site from the Australian Federal Police for approximately $30 million in 2017. The site is set to have 250 townhouses constructed on it. Demolition will roughly cost $2.1 million for removal of current buildings on site. These townhouses are expected to sell for a price between $530,000 and $700,000 each. There are 4 different stages to the construction, with the first stage taking an estimated 2 years to complete. In the Village Building Company's 2017 annual financial report, it was found that the company received all loans in 2017 at an interest rate of 5.01%.
There are several project evaluation techniques that can be used to determine if a project will be financially feasible. As Elise mentioned before, discounted cash flow methods are being utilised more often in recent times. These methods include the net profit value, the profitability index, and the internal rate of return. These have been applied to the proposed development by the Village Building Company below. The NPV was calculated to be $5,971,125. As this value is a positive number with an excess of nearly $6 million, the project should be accepted. If the discount rate is greater than 9%, however, the project would no longer be feasible according to the NPV, as the value generated would be negative. The exact value for the discount rate where the project will no longer be feasible can be seen below in the IRR. The IRR calculated turned out to be 9.012485%. The project will be feasible if it is accepted at a discount rate lower than this value. If a discount rate cannot be achieved lower than this, then the project should not be accepted. The profitability index of the project worked out to be 1.0774. As the profitability index is greater than 1, the project should be accepted, as it is proposed as being feasible. After reviewing the studies found by Graham and Harvey in 2001, it is most likely the Village Building Company took most of the NPV when deciding whether their proposal would be feasible or not. This is because the company is a relatively modern, high-levered company. It is also highly likely that they analyse the calculated IRR and look to achieve the best discount rate to try and maximise their profits. Another type of project evaluation is the payback period. For the proposed development, the total cash inflow over the 8-year period is $153,750,000. As the project is split into 4 stages that each last 2 years, it could be assumed that at each stage has a cash inflow of $38,437,500, which was derived by dividing the total cash inflow by 4. This equates to an approximate annual cash inflow of $19,218,750. The payback period was then calculated to be 4.01 years. As seen in the calculation period, the proposed development is just over 4 years. This, however, is not particularly accurate as it does not factor in the time value of money.
Considering the Village Building Company's annual financial report for 2017 and the general history of property development groups in Australia, this can indicate how the firm's proposed project is funded. The interest rate of bank loans the firm receives has been established at an average of 5.01%, and the initial investment, including land cost and demolition, is $32,100,000. The total required loan repayment amounts to $33,708,210. The company often undertakes several projects at once, and 5.01% interest is relatively low for an 8-year fixed loan. This can indicate one of 2 sources as to how the firm has obtained their funding. As a preferred option for a firm of this size would likely be to use past projects and assets as collateral, thereby allowing the bank to seize these assets in the case that they fail to repay the loan by the predetermined payback period. This project could be highly leveraged using the recent acquisition of the Big Banana theme park as collateral, thereby allowing themselves to not have to contribute any deposit and keeping the interest rate relatively low. Highly leveraged companies do this as to avoid contributing their own capital towards a project but keeping all the profit.
An important piece of information that any company should use in their financial decision making is whether to adopt a new construction project is determining the break-even point in a project. A break-even point is a point in the project where the total revenue equals total cost in the project. At this point, neither a profit or a loss is being made, therefore your result is you break even. It's important for any construction company to determine this number, as it will give you an idea of how much money must be made for the project to be profitable. An important step in determining the break-even point of a project is to find the variable and fixed costs of the project. The fixed costs for the Village Building Company's Western Creek project will consist of the wages paid to the various contract workers, as well as the pre-specified materials that have already been bought, so it can roughly be estimated at $71,190,000 for the whole project. The variable costs for the Village Building Company's project in Western Creek will be all of the raw material they buy to build the units. This can be estimated at around $50,000 per unit built.
Results from the findings and analysis of the study provide valuable insights as to the feasibility and legitimacy of the Village Building Company undertaking a large-scale project such as this. Based on our research design, we investigated the project firstly by applying discounted cash flow techniques. This was used to determine if the company would profit from the project. As all the techniques implemented informed us the company can profit, the next analysis was to determine the source of the financing and the cash flow forecast over the course of the project. As all the techniques implemented informed us the company can, given they only needed a loan for the initial investment and the rest is their own capital, they had taken a loan of $33,708,210. The possibilities of how much they deposited for the loan were investigated, and the results indicated that they either provided a high deposit, which is unlikely as they are already using their own capital to develop the entire project and pay the contractors. The implication from the nature of the amount borrowed for the project is that they borrowed 100% of the initial investment cost and provided the bank with collateral of their other assets in case of failure to pay. Furthermore, The cash flow forecast determined that the biannual profit for the firm was $10,735,447.50, which is including the bank repayments. This forecast further reinforces the feasibility of the project. Finally, the break-even point was investigated, which provided a valuable insight that 126 units must be sold in order to at least repay bank loans and cover all cash outflows. This is 50.4% of the total expected number of units. This requirement is very achievable and just further reinforces the validity of undertaking the project. Ostensibly, the design intent of the study was to determine the feasibility of the Village Building Company's project in Western Creek. In light of all the evidence, the project seems to be profitable and relatively economically safe to pursue.